Hi everyone, it's Steve Boyce and Mike Hayward from Capital Partners, and we're talking today about mindset when it comes to investing. So Mikey, just as a starting question, why does mindset matter when it comes to investing?
Mindset's crucial, I reckon, Steve. You know, when you're investing in share markets, as you know, they can be wild rides. You know, markets go up, markets go down, and when I find people's emotions are really tied to how share markets are going. So if we have a market fall or a correction, you know, as recently as early 2020, when the Australian share market dropped 35% in about 4 weeks, that people can be really fearful. But you've got to see through, you have to see through those falls to benefit from the long-term returns that share markets offer.
Yeah.
What's been your...
Well, I think very similar, but it's also, for me, just as a fundamental when it comes to investing, you have to be optimistic. So there's always something going wrong in the world. So if you kind of think about, you know, even in the last few years, we've had COVID, we've had geopolitical issues, we've had the Ukraine-Russia war, we've had the Israel-Hamas issue, obviously in recent times. We've had rising inflation, we've had rising interest rates. There's always so much negativity, and there's always a reason not to be invested or to sell out. But I think from a longer term perspective, it's always paid off to be an optimist when it comes to investing. So what we know about long-term investment returns is that you could reasonably expect, being just invested in a diversified portfolio in share markets, somewhere between 8 and 11%. But geez, it can be a really wild ride. Yeah.
So taking that long-term perspective, always remaining focused on, it doesn't matter what happens in share markets in the short term, because we know they'll go down, we know they'll go up. But I like to say there's more ups than there are downs over the long term, right?
Yeah.
So you just got to take that long-term perspective.
Yeah. And I think the other thing is it's really interesting. We're looking at some research and some data recently, and even in those periods where, you know, for example, in calendar year 2023, like broadly markets were up somewhere between 15 and 20% if you look at kind of Australian and American markets. But even throughout the year, there was 2 or 3 occasions where the market actually fell between 5 and 15%. So while it's generally trending in an upwards direction, you get those pullbacks which kind of happen within the year. So if you had have sold out, for example, last year we saw, you know, the Israel-Hamas issue come to head. If you had have sold out during that period and panicked and got out of the market, because your mindset is one of fear rather than one of like optimism for the long term, you would have missed out on a really strong market return.
You have to be there, right? You have to be invested and hold the line throughout those tough times to benefit from the recovery.
Absolutely, 100%.
What sort of conversations are you having with clients when markets are shaky?
I think that's a really good question, because I think so much of what we do as advisors is communication. And it's so interesting when you see when we start, and you would see this as well, when we start working with a new client who perhaps hasn't had the same level of experience and the same knowledge, or maybe invested in a different methodology where they were trying to kind of time in and out of the market. There's definitely an education process that happens in that first probably 1 to 2 years. And I think people need to actually experience the ups and the downs and actually understand that, yep, you know, this actually happens pretty regularly. And when it does happen, it's like, yep, you know, hold on to your seats. It's never pleasant as you're going through it, but it's not the end of the world. So I think how we can help is just the education process, like how we talk to clients, how we communicate. And in particular, this is a lesson I learned a long time ago, it's all good to talk to people and to be, you know, on the front foot with your communication when things are going really well, but it's when markets are not going well, that's when people need the most help. They need the counsel, they need the, the hand on the shoulder, the hug to say, yep, it's not pleasant at the moment, but it's all going to be okay. And I think, at Capital Partners, that's where where I think we stand out a bit in terms of the communication when things aren't going so well is just as proactive as when it's happy days for markets. Yeah.
Absolutely. And it's, you're almost you're almost referring back to the first couple of years of conversations with the client when that happens, right? So I guess the work that we're doing together with those new clients in the first couple of years is helping them adjust their mindset that we are going to go through a period of time where share markets are down. We're going to report to you and your portfolio is going to be down in value. But we're setting the expectation that when that's the case, you know they're going to expect what we're going to say at that point in time. So when the market's down and we are advising them to stay the course, remain invested, remain disciplined, it's going to be no surprise. It'll still be tough for them emotionally, but no surprises. We're on the front foot and we're advising you exactly how we said we would right from the word go.
Yeah. Have you ever dealt with any clients where they have been just like really fearful of the gyrations, the ups and the downs of markets? And how have you kind of dealt with that personality type?
Yeah, I have, and there's a lot of hand-holding, I think, that happens through that time, and that's why we're there, because we want clients to avoid making the wrong decision, which is selling out at the wrong time, because that's when you make a loss. So being there, holding their hand, helping them through, staying focused. I think from experience, Steve, helping clients remain focused on the long term really helps get them through those ups and downs in the short term. Remaining focused on why we're invested that way. What are the goals that we're working towards? What's the investments? Why are they invested that way and delivering, the long-term return that we want, that we need them to deliver so they can achieve their goals over the long term.
Can you, like one of the fascinating conversations that I always have particularly with new clients, is the difference between investing and speculation. Can you just unpack that a little bit?
Good question. I think the way that I would describe it is investing is having a really considered and structured plan of attack, making really sensible decisions, having an aligned investment philosophy that is not trying to pick the next best thing, that's not trying to pick winners. It's highly diversified, it's evidence-based, and it's going to support the client to achieve the goals that they've set. Speculation, on the other hand, is, I think lithium is going to be the next best thing, or I think this bank is going to beat this bank, so we're going to buy these stocks and we're going to trade it, or spooky magic type stuff, forecasting the future. And all the evidence suggests it just doesn't work reliably over the long term. What's your view on that?
So I'm very much in agreement with what you just said. I think when people are younger, particularly men, there's a bit of a rite of passage in terms of you need to learn, you need to do it yourself a little bit, you need to learn maybe some hard lessons. I definitely experienced that when I was younger. And maybe it is when you're younger, you can speculate a bit more. So for example, you might be buying speculative shares. You hear lots of people at the moment who are buying cryptocurrency. And even kind of when it comes to trading shares, you do see a lot of people who, when they're younger, it might be, I'm going to buy BHP when it's low and try and sell it when it's high. And I think there's this rite of passage that people experience where they want to do it themselves. They're learning valuable lessons because they learn that it's actually not that easy. If it was as easy as just buy low, sell high, everyone would do it. Or just, there wouldn't be the need for financial advisors or for people to help manage money. And then I think what happens is that people just get to a point in their lives where they realise one of two things. I think the first being there's no second chances. So they're like, actually, we can't stuff this up anymore. Like we need to make sure that however we manage our money is done in a way that's professional, that's not going to let us down, and that's going to get us really dependable returns. And I think the other thing people realise, and some people realise this and some don't, is that they just don't want to do it themselves. So people realise that actually, and there's a bit of humility and understanding your ego and understanding yourself a bit, that maybe I don't know everything, and maybe it might be a better thing for me to actually seek the guidance and help for someone, from someone who does this all the time. And can actually create something, or create a portfolio, create a strategy, as you were talking about, a plan that's going to, to not let them down, and it's going to actually deliver really reliable long-term investment returns. So for me, that's investment versus speculation. Investment is just when you want something that's reliable, dependable, not going to let you down, and I think is aligned with what you and your family are actually seeking to achieve as well.
Absolutely.
Yeah.
And when we're helping clients and building those portfolios, there's things that we can control and we can't control, right? Can you help me understand that a little bit more?
Yeah, so I think definitely when it comes to things that you can and can't control, I think, again, that comes back to humility. And one of the things that people always think when it comes to investing is that there's some secret sauce, that there's a crystal ball that you can predict where the market's going, and you should be able to kind of buy at the low points and sell at the high points. And one of the stories I tell a lot of my clients is at the start of every calendar year, if you look at the Australian Financial Review or the West Australian, all the big media publications, you'll see forecasts from economists. So, economists saying this is where interest rates are going to go, this is where inflation is going to go. You'll have market commentators saying this is where we expect the market to go in the next 12 months. And I always find it fascinating to, at the end of the calendar year, reflect back on, how good people were at actually predicting. And the reality is, the answer is pretty poor almost all of the time, which is completely understandable because no one can predict the future. No one knows when a war is going to happen. No one knows when, we might kind of be coming up to a recession or, some issue which is going to kind of impact markets. So for me, the things that you can control is having a plan. It's being really clear on what you want the money to achieve for you, and building a robust, reliable investment that is going to deliver you long-term returns without having to worry about the day-by-day minutiae of what the market is doing and trying to predict where it's heading. What about for yourself? What does that?
Yeah, I'd build on that, Steve. I agree with everything you've said. You can almost go a little bit deeper. And when the things that you can control when you're constructing a portfolio, we need to understand what's the rate of return that you need to achieve the goals. So we make sure the asset allocation is right, the allocation to equities, and the allocation to bonds as the secure part of the portfolio. So much so to say, if a client is in drawdown mode, let's make sure at minimum the client might have 4 to 6 years of their living needs held in these secure assets. So it doesn't matter what happens in share markets in the short term. They can go down, they can go back up. And the client doesn't have to sell at the wrong time. So it's all that planning. You referred to planning. It's all the planning that goes in right at the start.
Do you often see, particularly if you have clients who come to you, where there hasn't been that planning? Is that a common thing for you to see? There's just like a investment portfolio without any thought behind it?
Yeah, quite often. Yeah, quite often. It's that traditional wealth management thinking where they just start with the money. What do you got in super? Can we roll it over to a different fund? But I'm preaching to the converted. You can't start with the money. You've got to start with the person, right? What do they want to achieve? What's the most important to them? And then we work back. We work backwards. What does the plan need to deliver? Step-by-step plan. Investment is a big part of that, absolutely, but you can't start there. And so you do see those portfolios where it's just a mix of things and doesn't appear like there's a clear direction or a clear objective. Yeah.
I think even further to that, the other thing that I find fascinating is different investor personalities. So often you'll have like a couple that comes in to see you, and one of the partners might be really conservative, so they might not understand investing that well. And so as a result of that, it's like, we're going to hold money in cash, or it's just fearful of getting into the market or investing because they don't understand it. And on the absolute opposite to that, you might have someone who comes in and, it could be, the same couple, and the other person is like a risk taker. So they might be a business owner and they're used to kind of investing in private companies and speculative shares and like taking a lot of risk. So I think when it comes to building a plan, it's not necessarily as easy as just saying, it's just going to kind of magically appear. That's why the person is so important, or the people. It's understanding what motivates both people, what their investor personalities, how they think about money, how they interact with money, how they interact with each other. And then once you're clear on that, you can actually build a plan that's going to give peace of mind to both, to both of them. And sometimes it is, we don't say to clients everything needs to be invested in a diversified portfolio. If one of them, for example, wants a bit more fun and a bit more speculation. But it's all about creating something that is highly dependable, particularly around their core goals. So you really want to make sure you have a plan and a strategy as a family for the core, the core long-term goals, the things you need to be funded for the long term. There needs to be a certain amount of capital allocated and invested in a way that's highly dependable that's going to achieve that. And if you have surplus capital on top of that, then completely fine. You can set aside a smaller amount of money to invest in things that might give you a bit more excitement. So we're certainly not the fun police on that front, but you need to be careful. Like that's where the plan and the strategy and the thinking needs to be robust to make sure it fits the entire family.
Yeah, totally agree. So there's lots of stuff that we can control up front, but as you know, there's lots of stuff we can't control. I'm thinking of one major thing, but can you...
I'd love to hear what your one major thing is now.
So open to you first though. What's something that we can't control, or what clients can't control on the journey?
Well, I think there's lots. Like there really is. Like if you kind of think about life in general, there are so many things you can't control. Like obviously you can go back to the investment markets and say, from an investment perspective, you're going to have ups and the downs. You can't predict where things are going. It's an uncontrollable, like what's going to happen in the market. But life throws curveballs as well. So, you can't control health. You can't control, what's going to happen with your kids and your family. So what we find is that often part of our initial work is building a strategic plan at the front end of, when we engage with a client. But what we see is that people think that it's going to be something that, it's going to be pretty static over time, but it just never ends up like that because people's goals change, their values change, their family situation changes, the economic situation they're under might change as well. So you've always got to be making sure that, that you're just tinkering with your plan over time as these changes happen to make sure you kind of stay on track. I always kind of use the analogy of if you kind of think that you're a sailboat and you're heading in a certain direction, you'll have winds, you'll have tides that'll kind of drift you slightly off course. And it's just every now and again, you just need to be nudged back on course.
That's a good analogy.
Yeah. So what's your one big thing?
Well, I was actually thinking about investment markets, but you were absolutely right. There are a whole range of other things that are outside of our control. But what I was leaning towards is in the short term, investment markets are really volatile, and out of everyone's control. So it sort of links back to the mindset and how we have conversations with clients and hold their hand for the whole journey, ups and downs. More importantly, like you said earlier, the downtimes, because it's when you sell out at the bottom of the market, when you're most fearful, is when you make a loss. But our experience with working with clients for a long time now is they stay the course, they hold the line, you remain invested, you remain disciplined. It's the same message, but it works. And yeah, sure, markets go down, their portfolios go down in the short term, but they go up over the long term, and they have for clients. And seeing clients through the tough times and benefiting from the good times, it's just so rewarding, especially when they say, thank you for holding my hand during those tough times, because if I was doing it myself, I reckon I may have sold out. And they get to the point and they've achieved their goals, and that is just brilliant. It's just such a rewarding position to be in.
Yeah. And I think there's some great research that always comes out from the big super funds around asset allocation. And if you look at any big market retracement, so for example, the global financial crisis or recently with COVID in 2020, it's amazing in terms of if you look at kind of the market going down, when people, like if you look across like, all of the investors within these big super funds, you'll see as the market's going down, the amount of people that move into cash go up. So people become fearful, the market's going down, and because people are not getting great advice, they're panicking, they're stressed, they're anxious, they're worried about their retirement and their future, they move to cash, and they move to cash at exactly the wrong time. So that hand-holding and that advice when things are not going well is actually the advice that makes the biggest difference, because human nature is such that if you see things going down, it's like completely normal to kind of panic and react to that.
We're emotional beings, aren't we?
Yeah, 100%.
And when you're most fearful and lots of people are going to cash, it's actually the wrong decision to make, isn't it?
100%, yeah.
That's when you buy.
That's when you buy.
And when things are going up and people are, for use of a better term, ecstatic, greedy, they want to buy in, don't they?
Yep.
But it's actually the time that you rebalance your portfolio. You take some profits and you top up your defensive assets and you hold the line.
Stay the course.
Stay the course.
So if we just to summarise this conversation, if you were looking at just the couple of things that people should be focusing on to get a good investment outcome and to be able to manage those emotions, what would you say were the couple of things that come to mind for you?
A couple of key things would be start with the end in mind, and the end being what are the goals that you're aspiring to achieve. Make sure that you have a documented step-by-step plan around how you're going to actually achieve those goals. What is everything that you need to do? So you've got that financial plan, the guide to achieve the vision, and have a really good investment strategy and plan that supports your documented strategy to have you achieve the goals that you need and remain invested all the way through. What would be your couple of key things?
So 100% agree with what you've just said. The plan, the strategy, the long-term mindset's really important. But to build on that, I would also say you absolutely need, if you're married, you're husband, wife, or partners, everyone needs to be on the journey. It can't just be one person managing things and doing it themselves without the other one being part of the process. So I'd say make sure you build a plan that respects everyone in the family, and also understand yourself. Like understand what your strengths are, what your weaknesses are when it comes to investing, and get help from a really good advisor who can actually give you guidance and help you and help complement kind of your weaknesses in particular. So I'd say that's really important. And then the other thing that I think is really beneficial as well is there's a lot of noise. So, you open up your phones, you read newspapers, we're bombarded with information all the time around, this recession's coming, interest rates are going up, inflation, geopolitical issues, wars. And I just counsel people just to dial that back a little bit. So it's fine to read and to consume information, but dial it back a little bit and don't necessarily make financial decisions based on kind of that short-term noise. Just see through it a little bit.